friends. This is the 16th session, the personal investment management. This session is for BCom open elective paper of third semester personal investment management, investment in stock market securities, and its risk involved in stock market investments. In the previous session, the students came to know about meaning of indices, need differences, computation of indices, and types of indices. Uh, to understand the risk involved in stock market before investing their money. The students will be able to know in which securities they have to invest, what are all various risk involved in it, etc. Risk involved in stock market investment. So before going for the risk, what is a risk? Risk is a very important concept in stock market. Risk is a deviation from expected outcome. What is the deviation from expected outcome? For example, you all know that in the cricketer Sachin Tendulkar, when he goes to crease, you all expect him to score at least 80 runs because he's having a very good career average. But sometimes what happens is he gets out for zero. So getting out for zero is a random variable. So that's a risky situation. So it's a deviation from an expected outcome. We are all expecting certain values. So if that is not happening, that is called a risky situation. So anything which is subject to random variable is called a risky situation. Random variable means that we are not able to exactly predict stock market prices. Could be one, it could be interest rate, it could be inflation, it could be whatever it may be, rate of interest as well. So these things which we cannot exactly predict, so that is subject to risky situation. So stock market is also investment is highly risky because it's also remunerative, or it will fetch you high return. Higher the risk, higher will be the return as well. So the market prices of stocks are subject to highly volatile conditions. Sometimes it might move in a reverse trends than what we expect, depending upon the external economic situation as well as internal economic situations. Stock market investment is risky, and there are different types of investment, namely equity, fixed deposits, debentures. There is a direct relation between risk and the return concepts as well. Uh, the risk might arise due to two, three important uh, background. One is that it could be due to the internal company factors. It could be the general industry factors, that is, industry in which company belongs to, or it could be general economic conditions as well. So, if the company specific is not performing very well due to some slumps in the market, or there's a problem of raw material procurement or finance problem, whatever problems they might encounter, due to that there's risk involved. Or it could be due to the industry specific factors. The industry is not doing well due to depression or recessions or whatever reasons, or general economic condition throughout the globe is itself is not good, and that is also a risky situation. Risk could be of two types. One is systematic risk, another one is unsystematic risk. Of course, there is one more risk which is called systemic risk, but should not be confused with systematic risk. Systematic risk, Andrea, systematic risk is the overall day-to-day ongoing risk that can be caused by a combination of factors including the economy, interest rates, geopolitical issues, corporate health, and other factors. Day-to-day ongoing risk. It is due to the combination of factors including the economy. It could be general economic factors like recession, continuous bad economic policy, bad monetary policy, or some kind of global downturn, or all these general economic. It could be the low interest rate related specific factors, or it could be geopolitical issues, could be due to war or alien enemy countries policies, or some kind of policy, or corporate health policy and other factors. So that is called systematic risk, which risk is ongoing risks that can be caused by combination of all these factors. Then unsystematic risk. Unsystematic risk is the threat related to specific security or portfolio of securities. That could be related to a single security. ಒಂದು ಸೆಕ್ಯೂರಿಟಿನ ಮೇಲೆ ಇರ್ತಕ್ಕಂಥ ರಿಸ್ಕ್ ದಟ್ಸ್ ಕಾಲ್ಡ್ ಅನ್ಸಿಸ್ಟಮ್ಯಾಟಿಕ್ ರಿಸ್ಕ್. Threat related to a specific security or a portfolio of security. Investors construct these diverse portfolio for allocating risk on over various classes of assets. So this risk can be diversified. Diversified ಅಂದ್ರೆ ಏನು? Diversified ಅಂದ್ರೆ ಈ risks ಅನ್ನ don't put all your eggs into same basket because it's a risky situation. If the basket falls, entire eggs will be, you know, rotten, and that's what the problem. So don't try to invest all your assets, all your investment revenue, investment opportunities into one companies or two companies. Instead, you just try to invest in different companies so that your risk can be mitigated. Loss in one can be made good by others. Profit in one or loss in one could be offset by the profit of other company. So this is how you have to invest. That's a risk systematic diverse portfolio. Any risk that is confined only to a particular sector or a particular company is known as unsystematic risk. And if you are not, your unsystematic risk is undiversified risk. That is, you're going to just invest only in one security. So that's unsystematic risk. So source of uninsured risk is many. Like if you're not investing in only many companies. So sometimes index is also based on in order to have a systematic method in which all companies securities are selected in that. If you're investing on the risk, index based securities, that is also good for you. Um then there are differences between systematic risk as well as unsystematic risk. There is one more thing which is called systemic risk. Systemic risk is a risk which is accruing in entire economy, and it could be due to very bad pathetic conditions in the entire general economy throughout the globe. Maybe recession, maybe depression, or maybe huge economic downturn, or it could be, for example, 2008 financial crisis cases, or 1929 to 1936 of depression, Great Depression. These are all the entire system. It's not working, and the systemic failures like failure of bank or lack of faith in the systems. That's a systemic risk. So basically, there are two types of risk. One is systematic risk and unsystematic risk. Also, there is one more risk is called systemic risk. Okay, so I hope you'll be able to understand this uh, very well. And in case if you have doubts, you can feel free to contact us. Thank you.